uh, what to expect from the Fed. That's exactly what everyone's going to think about. We have Steve Brice, the Chief Investment Officer at Standard Chartered Wealth Management, joining us to help us parse the global cues. Good morning, Steve. Thank you very much for sparing time for us this morning. Well, what are you expecting in the FOMC minutes? And irrespective of what is expected, is much of the bad news priced? Because we have seen for the past couple of weeks, the S&P, the NASDAQ and the Dow actually, falling rather steeply.
So, I mean, on the first thing, obviously, the Fed's inflation outlook, they revised up their inflation outlook. So more information as to why they did that, I think is going to be really important for investors. To see whether the data that's come in recently sort of fights that. If they're focused on the labour market still looks pretty tight. Yes, we've seen job offers, which obviously is due tonight, that they have started to come down, but still massively above pre-pandemic levels. Initial jobless claims are nothing to worry about. So, if you're looking even at the coincident indicators of the labour market, it suggests that the Fed still may feel it has some work to do. In terms of is this priced? I think increasingly this has been priced, obviously, by rates markets. We do believe that we will actually they'll over tighten. So we liken it to going to a buffet and eating a lot of food very early and then getting indigestion later. So we think the Fed will over tighten, and that will lead to the need to cut rates later in the year. But for the focus in the near term, I think it's going to be, we still think we're heading into recession. And therefore, we do think there's still another leg down from an equity market perspective.
Okay, so we're heading into a recession and perhaps another leg down for equity markets. Steve, good morning. Do you think India can buck the trend? Because we've been doing that so far.
Yeah, it's been very resilient, right? So, I mean, within the context of our asset allocation models, we are overweight Asia ex-Japan. Within that, we switched from being overweight India at the end of last year to being neutral and switched to being overweight China. Obviously, that's working out pretty well for us at the moment, given the performance of the China markets. Nothing wrong with India. India's stock market's holding up well, but relative performance, we expect China to outperform as we move through certainly the first half of this year, and then we'll see how things sit.
All right. Hi, Steve. Morning. You said that maybe a recession could come about. That's what you're factoring in, and then a bit of a pullback in equity markets. What could that be? What are you penciling in? A 10% or 15%, or is it more?
I think we'd probably say more. Given that the fact that we've rallied so strongly from the lows, is that the first question alluded to. We could see the US stock market fall quite markedly back to sort of towards low 3000s level at some point before we form a base, and obviously then you see people looking forward to the ultimate recovery, and assuming the Fed does pivot away from slamming on the brakes, which is what it's doing at the moment, to actually initially taking the foot off the brakes and then ultimately putting a foot on the accelerator at some point later in the year. So that's the sort of magnitude of potential weakness that we see for the US stock market.
Steve, you're talking about a 25% drawdown on the S&P 500.
Well, I mean, yeah, so maybe 3,300, I think, is really critical support. But, yes, we wouldn't rule out, another 15-20% certainly downside from here.
Okay, that's big, Steve. Yes, even in 2022, we weathered a 20% drop in the big indexes in the US, and the Indian Nifty moved up 4% in rupee terms. Okay. Now, what's the expectation in 2023? Do you think a similar outperformance, a marginal uptick in Nifty? What are the options?
Yeah, I guess, for us, the critical piece for the story is what happens to currencies, right? So obviously the rupee has been a bit on the back foot in most of last year against the backdrop of a very strong dollar globally. We do expect, we've obviously already seen the dollar weaken quite considerably from the highs globally, less so against the rupee so far. But I think that reduction in pressure from the dollar strength and further weakness as we go through the year, we think that will be a good backdrop for Asia generally, and obviously for India as well, especially if oil prices don't continue to rally or rally further from here. So from that backdrop, India probably modestly higher, not dramatically higher, but still, delivering decent returns.
Since you have switched from overweight to neutral in India, you also believe that there's a recession coming. Do you think that equities as an asset class may move to the back burner this year and there are better returns perhaps in gold or even in debt?
Yeah, so it depends where you're looking. If you're looking globally, we certainly believe that's the case. So we're overweight investment grade corporate bonds in the developed market world, and we have we're neutral there, but we still think the yields there are attractive. In Asia, we are overweight in high quality debt as well. Again, seeing flows picking up into that asset class, obviously with the property situation becoming much more calm in China being an important point. If we're looking closer to your home in India, we're actually pretty balanced between bonds and equities. So within equities, we have a tilt towards large cap companies, where we see earnings growth, resilience, and valuations looking more attractive, margin of safety looking good as well. And from a sector perspective, preferring the domestic economy, we see domestic economic resilience in India relative to what's going on elsewhere. So preferring sectors such as financials, industrials, consumer staples in India, as we believe those will be more resilient as we head through 2023.
All right, Steve, final question then on the dollar index. Went around 150 odd. I recall you telling us that you believe that it's not yet peaked out at around 104.5 odd. Where do you see this one heading?
Yeah, so we've been obviously we've been bearish on the longer term outlook, but thinking that there could be some short term strength coming through. I guess given our Fed view that maybe there still is some tightening yet to come, and maybe that could surprise a little bit on the upside. That could give the dollar some support in the short term, but we'd be looking at any rally in the dollar as a good opportunity to sell on a 12-month basis.
Okay. All right, we will leave it at that. Steve Brice, pleasure speaking with you. Thank you very much for joining us, and have a fabulous 2023. We are still meeting you in the first week of the year. Thank you.
Thank you.
Thank you, Steve. All right, with that, we'll take our first break for the morning. And before that, after the break, our list of top 10 stocks lined up for you.